payment of VAT. Late payment of VAT constitutes an offense, and the offense is failing to remit the VAT due to Kenya Revenue Authority by the 20th of the following month. What is the penalty? The penalty is 5% of the amount due. Greetings and welcome. I'm back to continue with the topic mergers and acquisitions. The subject is advanced financial management. We've been studying the various methods that we can use in valuation of a target company for mergers and acquisition purposes. So far, we've done the net asset basis method, the PE ratio basis method, the dividend growth model. We covered the super profits model. In our last session, we analyzed the capital asset pricing model. Today, we move to cover the last model, which is the discounted free cash flows basis. The discounted free cash flows basis. Discounted free cash flows basis is a fundamental and widely used valuation technique in mergers and acquisitions, and it estimates the intrinsic value of a company by projecting its future cash flows and then discounting them back to their present value. It involves predicting or projecting the future cash flows of companies, then discounting the cash flows back into their present value. The method is based on the principle that the value of a business is the sum of its future cash flows discounted to reflect the time value of money and the risk associated with those cash flows. And in mergers and acquisitions, it's used to determine the price a buyer should be willing to pay for a target company or the price a seller should accept. So in this lesson, we are going to outline the steps in discounted cash flows basis method. Then we will work out an illustrative example in our next session. First of all, let's analyze the steps. If you are to value a target company for the purposes of acquiring it or merging with another company, how do you go about it? The first step is to project free cash flows. Project future free cash flows. 1. Project future free cash flows. Project future free cash flows. And this is the most critical and often the most challenging step. It involves forecasting the target company's future financial performance, typically over a period of 5 to 10 years. Right? Projecting the future cash flows of the target company. Do you understand? Then there is what we call, this is A. B, there is what we call the free cash flow to firm. 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 FCFF. Free cash flow to firm. Free cash flow to firm. This represents the cash flows available to all capital providers. The cash flow available to all the capital providers, that is the equity holders and the debt holders, the free equity to firm. And how do you calculate the free equity to firm? The free cash flow to firm? Now, to calculate the free cash flow to firm, first of all, we have the earnings before interest and tax. You take the EBIT, earnings before interest and tax, multiply by 1. This is 1 minus T. The corporation tax rate. You add depreciation. You add depreciation and amortization. You add the depreciation and amortization. Take first of all the earnings before interest and tax, multiply by 1 minus t. T is the tax rate. You add the depreciation and amortization. Then you deduct the capital expenditures. Deduct the capital expenditures. Expenditures. Earnings before interest and tax times 1 minus t plus depreciation and amortization minus the capital expenditures. Then you also deduct the changes in net working capital. Deduct changes in net working capital. Deduct changes in net working capital. That will give you the free cash flow to firm. Free cash flow to firm. Free cash flow to firm is equal to AB times 1 minus T plus depreciation and amortization minus capital expenditures minus changes in net working capital. Changes in net working capital. That is the free cash flow to firm. Then C, we have free cash flow to equity. Free cash flow to equity. Free cash flow to equity. FCFE. Free cash flow to equity. Free cash flow to equity represents the cash flow available only to equity holders. Free cash flow to equity represents the cash flows available to only equity holders. The free cash flow to the firm represents the cash flow available to both debt holders and equity holders. It represents the cash available to all the providers of capital. That is the debt holders and capital holders. Free cash flow to equity. Now to calculate the free cash flow to equity, we're going to take the net income. First of all, we begin with the net income. Then we add depreciation and amortization, deduct capital expenditures, then we add changes in net working capital. To calculate the free cash flow to equity, we begin with the net income, we add depreciation and amortization, we deduct the capital expenditures, then we also deduct changes, we deduct changes in net working capital. Deduct changes in net working capital. Then of course, lastly, we add the net borrowings. Let me write it here. Net. We add the net borrowings. That's the only difference. We add here the net borrowings. We add the net borrowings. That will give us a free cash flow to equity. Now in mergers and acquisitions, the free cash flow to the firm is commonly used. The free cash flow to the firm is commonly used. Why? Because it values the entire company. In mergers and acquisitions, free cash flow to the firm is commonly used. Why? Because it values the entire firm, the enterprise firm, what we call enterprise value. It values the entire firm, which is then adjusted for net debt to arrive at equity value. You understand, candidates? The free cash flow to the firm is the total, is commonly used because it values the entire firm, what we are calling the enterprise value. It gives you the enterprise value. After arriving at the value of the entire firm, the enterprise value, then you adjust for net debt to arrive at equity value. So if you have the enterprise value, to arrive at the equity value, you just take, let me say, equity value will then be equal to enterprise value minus the debt value. So if you have the enterprise value and you have the debt value, you adjust it for debt value to get the enterprise value. That's very important. Then E, moving on to E, we have projections. The projections in the discounted free cash flows basis, projections require detailed assumptions about revenue growth, about profit margins, about capital expenditures, about, we've mentioned here, working capital, about the working capital needs. You have the changes in working capital. You have to make assumptions. The projections, because we are using the projected cash flows. To arrive at the projected cash flows, you may need to make assumptions regarding the revenue growth, the profit margins, the capital expenditures, the working capital needs, including the tax rate, because here you also have a tax rate. You have to make projections. And these projections require assumptions. These assumptions are often based on historical performance, on industry trends, on management focus, and potential synergies from the acquisition. So that is what we can say about projections. So that's the first step. Projections. Project future cash flows. Project future cash flows. Projections. I've said that projections do what? Require detailed assumptions. Require assumptions. Okay? About revenue growth, profit margins, tax rates, working capital needs, and so on. So that is step number 1 in relation to projection. That is all you do. Then in step number 2, you determine the discount rate. The discount rate. Now, candidates, we are discussing the discounted free cash flow basis method that we use in valuing a target for mergers and acquisition purposes. Second step is determining the discount rate. The discount rate reflects the riskiness of the projected cash flows. Okay? It does what? It reflects the riskiness of the projected cash flows. It reflects the riskiness of the projected cash flows. The discount rate does what? Reflects the riskiness of the projected cash flows. And the most common discounting rate for free cash flow to firm is the weighted average cost of capital. The weighted average cost of capital. A. B, we have the weighted average cost of capital, which is the most common discount rate for free cash flow to firm. The entire firm, if you are doing the projections of valuation for the entire firm, we use the weighted average cost of capital. The weighted average cost of capital is the most commonly used discount rate because it represents the average cost of all companies' capital. Of all companies' capital, weighted average, we are talking about the cost of capital of both the debt capital and equity capital, weights. Because you have the weights and the cost candidates, we know the weighted average cost of capital is equal to the weight of equity times cost of equity plus the weight of debt times the cost of debt 1 minus T. That's how you calculate the weighted average cost of capital. It represents the average cost of all the company's capital, both equity and debt. Where KE is the cost of equity calculated using CPA. You recall that's what we discussed in our last session. We use the CPA in calculating the cost of equity. The cost of equity. When calculating the cost of equity, we use the CPA. Then you have the market value, okay, of equity and so on. Then C, we have the cost of equity. Discounting rate can also be cost of equity. The cost of equity. If using the free cash flow to equity, the cost of equity is used. If using free cash flow to equity, the cost of equity is used as a discounting rate. Do you understand? Yes. If you are using free cash flow to farm, this is used when you are using the free cash flow to farm. I mean, this is free cash flow to equity. When using free cash flow to equity, we use the cost of equity. Equity. Is that clear? We use the cost of equity as the discounting rate. And in mergers and acquisitions candidates, the discount rate may reflect the target's standalone risk. Let me put that down. In mergers and acquisitions, it's important to note that the discount rate may reflect the standalone risk. Standalone risk of the target. Okay? The standalone risk of the target. The target standalone risks, or the acquirer's risk, or what we call a pro forma risk profile for the combined entity. So it may be the standalone risk of the target, it could be the acquirer's risk, or combined risk. So that is step number 3. The third step is to calculate terminal value. I don't need to explain much about terminal value because you've covered this in your previous financial management lessons at the lower level. Because candidates, since it's impossible to project cash flows indefinitely, sometimes a terminal value is calculated to represent the value of all cash flows beyond the explicit forecast period. Okay? So the main cash flows here would be the projected future cash flows from the company. Then you have the terminal cash flows, the terminal value. And we know there are various methods for calculating the terminal value. We may use the perpetuity growth model. We can also use the exit multiple model and so on. Then once you have the cash flows from these terminal values and the projected future cash flows, step number 4 is to discount cash flows and terminal value. Discount cash flows and the terminal value. Discount the cash flows and the terminal value. You have to discount each projected cash flow. And the terminal value back to their present values using the chosen discount rate. It could be the weighted average cost of capital or the cost of equity. You discount. To discount cash flows means determining the present value of the cash flows. So you have to discount each cash flow back to the present value. All the cash flows. We begin with the cash flows for year 1. We discount by multiplying it by 1 plus R raised to 1. Then cash flows year 2, we divide by 1 plus R raised to 2, plus cash flows year 3, year 4, depending on the number of years. You go all like that, then you add the terminal cash flows. Terminal cash flows, you discount 1 plus R. If it's 10 years, it's 10 years. That is the formula for calculating the present value of the cash flows. Both the projected future cash flows should be discounted back to the present value together with the terminal cash flows. So where PV is the present value, CF is a free cash flow in year 1, CF1, R is the discounting rate, and these ones here are periods, 1, 2, 3, 10, these are number of years in the forecast period. Terminal value, that is the terminal value cash flows. Terminal value, the terminal value, calculate the, let me just call it terminal value. Terminal value year 10. So that is step number 4. You discount each projected free cash flow and the terminal value. These are the projected cash flows and the terminal value. Step number 5, calculate enterprise or targets value. Calculate the enterprise value or equity value. You calculate the enterprise value or the equity value. Now, if using free cash flow to farm, 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 what did we say? We say that the free cash flow to farm, this is the sum, we use the sum of the present values of the discounted free cash flows and the terminal value equal to the enterprise value. You understand? If using free cash flow to farm, the sum of the present values of the discounted free cash flows and the terminal value, these values here, these are two main components, the cash flows and the terminal, the sum, because you are adding all the cash flows together with the terminal value. The sum of the present values, these are the present value. The sum, when you get the total, equals the enterprise value. So this formula will give you the enterprise value. If you are using the free cash flow to farm, it equals the present value. You understand? The sum of the present values, let me just complete it. If using free cash flow to equity, the sum of the discounted cash flows and the terminal value will equal the enterprise value. If you are using the free cash flow to farm. But if using free cash flow to equity, if you are using free cash flow to equity, take note candidates, here the sum of the present value equals the equity value. The sum of present values will equal the equity, will be equal to the equity value. If using free cash flows to equity, the sum of the present values equal the equity value. You understand? Yes, that is very important. This is B. So then, to get equity value from enterprise value, what do you do? To get equity value, what are you supposed to do? To get equity value, I had given you a hint here, candidates. To get the equity value, this is the formula. to get the equity value. We had already done it there. To get the equity value, then we are going to get the difference between the enterprise value and the net debt. So equity value will be equal to the enterprise value minus the net debt value. Enterprise value is equal to the equity value is equal to enterprise value minus the net debt value. The net debt value is just equal to the total debt minus cash and cash equivalents. You understand? Yes, you do. Straightforward. Now let's briefly discuss some of the problems or challenges and advantages of this method. And the challenges are just related to the challenges for the other valuation techniques. Before you get to the challenge, the first advantage of this method is that it is that theoretical soundness. Pros. 1. Theoretical soundness. The first advantage, theoretical soundness. Now, based on fundamental economic principles, this method is theoretically sound because it values a company based on its ability to generate cash. The second advantage is that this method is comprehensive. The technique is comprehensive because it allows for detailed modeling of the target company's financial performance and impact of the acquisition. Flexibility. Another advantage is in relation to its flexibility. It's flexible. It can incorporate various assumptions about growth, about margins, about capital expenditures, and also synergies. Then lastly, 4, it is widely used. This technique is widely used, particularly when valuing large companies. These are 4 advantages. How about the drawbacks? What are the disadvantages of this technique? Number 1 is reliance on projections. Reliance on projections. Number 1, reliance on projections. How is it a disadvantage? How is relying on projections a disadvantage? It is a disadvantage because the accuracy of the valuation depends heavily on the accuracy of the cash flow projections, which are inherently uncertain. You cannot be certain about the future. 2, to assumptions. This method is sensitive to assumptions because small changes in key assumptions like the discount rate, the growth rate, or even the terminal value can have a significant impact on the valuation. There is another disadvantage in relation to complexity. Complexity, from the word complex. Building a robust DCF model requires significant financial expertise and judgment. It's not easy to use this method in valuing companies unless one has the relevant needed expertise. 4, terminal value dependence. Terminal value dependence. The terminal value often accounts for a large portion of the total value, making it a critical and potentially subjective component. Then lastly, market sentiment. How is market sentiment a limitation? Market sentiment. The DCF model is an intrinsic valuation method. That should be acknowledged. The DCF is an intrinsic valuation method, and it may not fully capture market sentiment or premiums paid in comparable transactions. So it may not reflect market sentiment because it is a technique that values. It is an intrinsic valuation method. So therefore, it may not reflect what the market expects. So this is all as far as the discounted cash flow, free cash flow basis or method or technique is concerned in mergers and acquisitions. The discounted free cash flow technique, just as we've discussed, is a very powerful technique, and it is widely used in valuation of targets in mergers and acquisitions. This technique provides a theoretically sound framework for estimating a company's intrinsic value based on a company's ability to generate cash flows. However, its reliance on projections, sensitivity to assumptions mean that it should be used in conjunction with other valuation methods such as the market multiples or the PE ratio basis to provide a more robust and well-supported valuation range. And when valuing mergers and acquisitions, to avoid failure or overvaluation or undervaluation of targets, due diligence is also critical to validate the assumptions used in the valuation models. So candidates, we have analyzed all the valuation techniques in valuing targets for the purposes of mergers and acquisitions. This is the last technique, discounted free cash flow method. We began by studying the net asset basis. We went to the PE ratio basis. We covered the dividend growth model. We also discussed about the super profits model, the capital asset pricing model. And in our next session, we will now be working out illustrative Kasne past paper examples for these techniques. I know there are some techniques that have not been tested. You recall some techniques like the capital pricing asset technique is not a standalone technique. So that's why you may find that it has not been tested before. It cannot stand alone. It has to be used in conjunction with other valuation models like the discounted free cash flow model. So we'll be looking at the other standalone techniques in our subsequent sessions. And if you have any questions, please feel free to post your questions and all your questions will be answered. Bye-bye. Hello and welcome back to the lesson. I'm back to continue with the subject on taxation. We're still on the topic on value-added tax. Today we are going to discuss the offenses in relation to value-added tax. Offenses in relation to value-added tax. And in Kenya, candidates, offenses related to value-added tax are primarily governed by the Tax Procedures Act and the Value-Added Tax, along with subsequent finance acts. So if you are to know the offenses under the VAT, under VAT in Kenya, you only need to read the Tax Procedures Act, then you read the Value-Added Tax Act and the subsequent finance acts. These laws outline various acts of non-compliance that constitute offenses, and these violations or offenses carry administrative penalties, interest, and in more severe cases, criminal prosecution leading to fines and imprisonment. So in this lesson, we're going to highlight the offenses in relation to value-added tax in Kenya. And these offenses are contained or governed by the Tax Procedures Act, the Value Added Tax, and Finance Acts. The first offense is failure to register or deregister for VAT. Failure to register and deregister for value added tax. Failure to register and deregister for VAT. That's the first offense. That is to mean operating a business whose supplies are taxable, or operating a business whose taxable supplies exceeds the threshold of 5 million Kenya shillings in any 12-month period without registering for value-added tax, that is an offense. Similarly, failing to apply for deregistration when no longer required to be a VAT registered person constitutes an offense in VAT. Failure to register or failure to deregister for VAT. Number 2 is an offense related to records. Failure to keep, retain, and also to maintain proper records. Failure to keep, retain, because registered persons are required first of all to keep the records, then you are also required to retain the records that you are keeping, and maintain proper records for VAT purposes. Failure to keep, retain, or maintain proper records. Not maintaining accurate and complete records for VAT related transactions such as sales, purchases, invoices, credit notes, and even debit notes for the prescribed period. And the period is generally 5 years for VAT records. That includes deliberately preparing or maintaining false documents. That is the offense. And the penalty is 10% of the amount of tax payable, subject to a minimum of 100,000 shillings. And if there is no tax payable, the penalty is 100,000 shillings. 3. Late filing of VAT returns. Late filing of VAT returns. Late filing of VAT returns. The offense candidate is failing to submit the monthly VAT return by the due date. The due date is 20th of the month following. Alright? 20th of the month following. So if you are to make a return for the month of January, then the deadline is 20th of February. If you are filing returns for February, then the deadline is 20th of March. If you are filing the VAT returns for March, the deadline is 20th of April. So late filing, if you are to file these returns after 20th of the following month, then that constitutes an offense, and there is a penalty for that. The penalty is whichever is higher, or 5% of the tax due, or 10,000 Kenya shillings. If 5% of the amount due is more than 10,000 shillings, then you pay that amount, which is in excess of 10,000 shillings. But if it is less than 10,000 shillings, then you pay the 10,000 shillings, whichever is higher. 4. Late payment of VAT. Late payment of VAT constitutes an offense, and the offense is failing to remit the VAT due to Kenya Revenue Authority by the 20th of the following month. What is the penalty? The penalty is 5% of the amount due plus interest of 1% per month on the unpaid tax until it's paid in full. Until it's paid in full. So late payment of VAT, and there is also that is the offense which comes with a penalty. Offense number 5. Offense number 5 is understating sales. Understating sales on one hand, or overstating input tax, or overstating tax. Understating sales or overstating input tax. When you do that, that gives rise to what we call a tax shortfall. It leads to a tax shortfall. It gives rise to a tax shortfall, and that is an offense. The offense is deliberately providing false or misleading statements or omitting information that results in a lower VAT liability. That leads to a lower VAT liability. That is an offense. That is to mean under declaring output tax or a higher VAT refund. You understand? This is a form of tax evasion, which is an offense. When you understate sales, then you are committing, deliberately understate sales, then you are committing an offense which constitutes tax evasion. That is an offense. The 6th offense in relation to VAT is fraudulent claim for a VAT refund. Fraudulent claim for VAT refund. Fraudulent claim for VAT refund. The offense is making a false or misleading claim for a VAT refund that one is not entitled to. If you are not entitled to a VAT refund and you make a claim for VAT refund, that constitutes an offense under VAT. And there is a penalty for that. Alright? There is a penalty for such. The penalty is 200% of the amount of the fraudulent claim. And this penalty is generally not eligible for waiver. When you make a fraudulent claim, you will pay 200 more. 200% of the claim that you've made fraudulently. 7. The 7th offense in relation to VAT is tax evasion. Tax evasion is an offense. And the offense is broadly, the offense include any deliberate act or omission designed to illegally reduce or avoid a tax liability, including VAT. And while it is not explicitly defined, it's treated similar to fraud, which means willful neglect. Fraud here means willful neglect or gross neglect under the Tax Procedures Act. Tax evasion is an offense. Number 8, offense number 8 is tax avoidance. Avoiding tax is also an offense, and this could be due to aggressive tax planning. And while you know, candidates, tax avoidance is illegal. You can avoid tax through proper tax planning. Avoiding tax is legal when structured within the confines of the law. All right? Within the confines of the law. And KRA can invoke general anti-avoidance rules if a transaction is whose primary purpose is to avoid tax. And just like evasion, the penalty is 200% of the amount of tax that would have been avoided. So that would be the penalty. Tax avoidance. 9, failure to comply with e-teams. Failure to comply with e-teams. failure to comply with electronic tax system. The offense is failure. So candidate, the penalty for failing to comply with e-TIMS is 100,000 shillings if satisfactory reasons for non-compliance are not provided within 14 days of KRA's request. So if one fails to comply with the e-TIMS and one does not provide satisfactory reasons why they are not complying with the e-TIMS, then that can attract a penalty of 100,000 shillings within 14 days. So failure to comply with e-TIMS is an offense. Number 10, offense number 10 is issuing invoices that are invalid. Issuing invalid or non-compliance tax invoices. Issuing invalid or non-compliant. Issuing invalid or issuing non-compliant tax invoices constitutes an offense. Issuing tax invoices that do not meet the prescribed requirements under the VAT Act, including those not generated from e-TIMS, that is an offense. And what is the consequence? That may lead to disallowance of input tax claims for the recipient and also penalties for the issuer. Offense number 11 is failure to deduct or remit withholding VAT. Failure to deduct or remit. Failure to deduct or failure to remit withholding tax. Withholding tax. This is for appointed agents. If a person is designated as a withholding VAT agent, failing to deduct and remit the specified VAT amounts to an offense. And the penalty is 10% of the amount of the tax involved, up to a maximum of 1 million Kenya shillings. And late payment may also attract interest. Number 12. The 12th offense is obstruction of authorized officers. Obstruction of authorized KRA officers. Obstruction. The offense is hindering, obstructing, or even refusing to cooperate with the Kenya Revenue Authority officers during audits, during inspections, or during investigations. And the penalty can attract fines and imprisonment. Offense number 13 is avoiding or abetting an offense. Avoiding or abetting an offense. Avoiding or abetting an offense. That means assisting or inciting or inducing another person to commit a VAT-related offense. And the penalty is that the person who does so is liable for the same sanctions as the offense committed. So these are 13 offenses in relation to VAT. One is failure to register or deregister for VAT. That's offense number 1. We've said that these offenses are primarily governed by the Tax Procedures Act and the VAT Act of 2012. Number 2, failure to keep, retain, or maintain proper records. 3, late filing of VAT returns. 4, late payment of VAT. 5, understating sales or overstating input tax, which leads to a tax shortfall. Number 6, fraudulent claiming for VAT refunds. 7, tax evasion. 8, tax avoidance. 9, failure to comply with the e-TIMS. 10, issuing invalid or non-compliant tax invoices. 11, failure to deduct or remit withholding tax. Number 12, obstruction of authorized officers. And lastly, avoiding or abetting an offense. So these are the offenses, candidates, and therefore it's very critical for VAT registered persons to be fully aware of these offenses and their associated penalties to ensure full compliance and avoid legal repercussions. Thank you for taking time to study with us. In our next session, we continue to share knowledge in taxation. Bye. Greetings, candidates, and welcome to the lesson. The subject is Public Finance and Taxation. We began the chapter on Introduction to Taxation. So far, we've covered 9 subtopics. Today, we are going to wind up the topic on Introduction to Taxation by studying the Revenue Authority, the Kenya Revenue Authority. And in studying the Kenya Revenue Authority, we will look at the structure, the functions, and the mandate of the Large and Medium Taxpayers Office. So first of all, we will begin with the structure of the Kenya Revenue Authority. And by now, I know you understand that the Kenya Revenue Authority is the principal government agency responsible for the assessment, collection, and accounting of all revenues in Kenya. And this authority is established by an Act of Parliament, Chapter 469 of the Laws of Kenya, effective from 1995. And the authority plays a crucial role in financing government's budget and facilitating economic growth. So in this lesson, first of all, we want to study the structure of Kenya Revenue Authority. Structure. The organizational structure of Kenya Revenue Authority. Now, the KRS organizational structure is designed to effectively manage its diverse functions and to cater to different taxpayer segments. And while specific departmental names and reporting lines can evolve, the general structure includes: 1, at the top, we have the board of directors. At the top, the general KRS organizational structure, at the top we have the board of directors, which provides strategic oversight and governance. And the chairman of the board is appointed by the President of Kenya. The chairman of the board is appointed by the President of Kenya. Then after the board of directors, we have the Commissioner General. Commissioner General, who is the CEO of the authority. The Commissioner General, the Chief Executive Officer. Now, the Chief Executive Officer leads the day-to-day management and operations, and the Commissioner General reports to the Board of Directors and also to the Cabinet Secretary responsible for finance. So the Commissioner General, who is the CEO of the Kenya Revenue Authority, reports to the Board of Directors and also to the Cabinet Secretary responsible for finance. Then after the Commissioner General, we have key departments or divisions. Key departments or divisions. The first key department is Domestic Taxes Department. Domestic Taxes Department. So KRA has key departments. KRA is broadly organized into several departments, each headed by a commissioner. And the first department is the Domestic Taxes Department. Domestic Taxes Department, which is responsible for income tax, VAT, and other domestic taxes. And this is where the large and medium taxpayer offices fall. This is where the large and medium tax offices fall. The second department is the Customs and Border Control Department. Customs and Border Control Department is the second key department or division within the KRA organizational structure. This department handles custom duties, import and export procedures, and border security. Number 3 is the Investigations and Enforcement Department. Investigations and Enforcement Department, which focuses on combating tax evasion and illicit trade. 4, there is a department called Intelligence and Strategic Operations. Intelligence and Strategic Operations. Intelligence and strategic operations deals with intelligence gathering and strategic interventions to enhance compliance. Number 5 is Corporate Support Services Department. Corporate Support Services Department provides internal support functions like human resources, finance, and administration. Corporate Support Services Department. Then we have Legal Services. We have another department called Legal Services and Board Coordination. Legal Services and Board Coordination. Legal Services and Board Coordination manages legal matters and provides support to the board. Moving on to the next department is what we call the Strategy, Innovation and Risk Management. Strategy, Innovation and Risk Management. Strategy, Innovation and Risk Management. Strategy, Innovation and Risk Management Department is a department that drives strategic planning, innovation, and risk management initiatives. Then lastly, we have the Kenya School of Revenue Administration. Kenya School of Revenue Administration. Kenya School of Revenue Administration. Kenya Revenue School. Kenya School of Revenue Administration. KESRA. KESRA is another key department within KRA, which is KRA's training arm specializing in tax and customs administration. Specializing in tax and customs administration. Understand, candidates? Candidates, we are outlining the KRA structure. So first of all, we have the board of directors at the top. We have the commissioner general. Then we have key departments. Then we also have 4 regional divisions. We have, apart from the key departments, we have regional divisions, and the purpose or the existence of these regional divisions is to bring services closer to taxpayers. KRA also has Also maintains regional service centers across the country. We have the Nairobi region, the southern region, the western region, and so on. So generally, candidates, that is the KRA's organizational structure. KRA's organizational structure. Let's move on to the functions of Kenya Revenue Authority. This is the structure. We've outlined the structure. Let's move on to the functions. Functions. Functions of Kenya Revenue Authority. Functions. What are the functions of the authority? Now, KRA has various functions. This authority performs various functions, and we are going to outline the core functions. The first one is assessment of revenue, revenue assessment, collection, and accounting. Revenue assessment, revenue collection, and revenue accounting is the first core function of the Kenya Revenue Authority. This is the primary mandate, which ensures all revenues due to the government are assessed, are collected, and properly accounted for in accordance with the law. Number 2, advisory role. Advisory role. This is to advise the government on matters related to tax policy, tax administration, and revenue collection. 3, trade facilitation. KRA also facilitates trade, and this it does by simplifying and expediting legitimate trade across borders, which enhances efficiency and reduces costs for businesses. 4, border control. Because remember, we identified one of the departments, the border control department, customs and border control department. So this department is in charge of managing and securing the country's borders, working to prevent smuggling, counterfeiting, and other illicit activities. 5, taxpayer services and taxpayer education. KRA offers taxpayer services and taxpayer education by providing comprehensive support to taxpayers, including education on tax obligations, assistance with the filing returns, resolving queries, and so on. And of late, KRA has leveraged digital platforms like the iTax for this purpose. Taxpayers services and education. Then you have enforcement. Number 6. Enforcement and compliance. Enforcement and compliance. Enforcement and compliance. To ensure compliance with tax laws and customs laws through audits, through investigations, and application of penalties for non-compliance is a role that the Kenya Revenue Authority also plays. It enforces and ensures that taxpayers comply with the laws in relation to customs laws, in relation to penalties, and so on. 7, dispute resolution. Dispute resolution is the 7th function of the Kenya Revenue Authority. Dispute resolution. This is to provide, it provides mechanisms for resolving tax disputes, including alternative dispute resolution processes and so on. The alternative dispute resolution processes. So that is yet another role. Then you have data management and analysis, number 8. data management and data analysis. Data management and data analysis. The authority collects, it also analyzes and leverages text data for informed decision making, for revenue forecasting, and identifying compliance risks. So these are 8 functions of the Kenya Revenue Authority. So let's move on, candidates, to the next part of this lesson, which is large and medium taxpayers office mandate within KRA. And KRA, like many modern revenue authorities, segments its taxpayer base to optimize what we call administrative efficiency and effectiveness. And this has led to the establishment of dedicated offices for large and medium taxpayers. Large and medium taxpayers. So we have large and medium payers. I've just mentioned that the Kenya Revenue Authority, just like many modern revenue authorities, segments its taxpayer base to optimize administrative efficiency and effectiveness, which has led to the establishment of dedicated offices we are calling large and medium taxpayers offices or office. So the large taxpayer office is responsible for managing the tax affairs of Kenya's largest businesses and corporations, which contribute a significant proportion of the country's tax revenue. So what is the mandate of the LTO, the Large Taxpayer Office? What is the mandate of Large Taxpayer Office? Let's begin with the Large Taxpayer Office. What is the mandate? What is the mandate of the Large Taxpayer Office? So we have the Large Taxpayer Office and the Medium Taxpayer Office. Let's begin with the Large Taxpayer Office. Now, the first mandate is holistic management. 1, holistic management. Holistic management. This means overseeing all tax types like income tax, VAT, excise duty for large taxpayers. 2, enhanced compliance. Number 2, enhanced compliance. That is to mean implementing tailored strategies to promote and enforce voluntary compliance among large taxpayers. And this often involves close relationship management and also deep understanding of their complex business operations. So the Large Taxpayers Office enhances compliance by trying to understand the complexities around the large scale businesses. The office establishes close relationship and deep understanding of the complex business operations of large taxpayers, and that is to help in enhancing compliance. 3, specialized audits. Specialized audits is another mandate of the LTO, the Large Taxpayers Office. That means conducting comprehensive and specialized tax audits to address complex tax issues such as transfer pricing, such as international taxation, and intricate corporate structures. 4, relationship management. Relationship management, let me add framework. Relationship management framework. Relationship management framework. That is to mean that the office, the Large Taxpayers Office, develops and maintains strong personalized relationships with the taxpayers to facilitate open communication, to address concerns, and also provide tailored services. And that includes assigning dedicated relationship managers to these large taxpayers. Relationship management framework is provided by this office. 5. Revenue mobilization. Revenue what? Revenue mobilization. That is to mean focusing on maximizing revenue collection from this critical segment, as large taxpayers are major contributors to the national budget, and KRA aims to collect a significant portion of its total base or total revenue from the large taxpayers. Revenue mobilization. You understand, candidates? We also have dispute resolution. Another mandate is dispute resolution. The large taxpayer office resolves disputes. It also resolves disputes. That means efficiently managing and resolving tax disputes with the large taxpayers. 7. Advisory and feedback. Advisory and feedback. The large taxpayers office provides insights and feedback to KRA's policy development regarding the impact of taxpayers, taxpayers regarding tax laws on large businesses. So KRA provides insights and feedback. I mean, the large taxpayers office provides insights and feedback to KRA's policy development regarding the impact of tax laws on large businesses. That is the LTO mandate. The LTO mandate. Let's now discuss the MTO mandate, Medium Taxpayers Office mandate. MTO mandate. MTO mandate. Now, while the Medium Taxpayers Office may now be integrated within the LTO as a co-functional area, the LTO has its specific mandates. Okay? Its specific mandate within the combined unit is to manage the tax affairs of medium-sized entities. So we have the Medium Taxpayers Office, whose mandate is to manage the affairs of medium-sized enterprises or entities. And the mandate include 1. Targeted administration. Targeted administration. That means providing tailored tax administration services to businesses that are larger than micro or small enterprises but do not meet the large taxpayer criteria. The second mandate of the MTO office is simplifying compliance. Simplifying compliance. To simplify compliance. That means conducting compliance checks and compliance audits that are appropriate for the size and complexity of the medium taxpayers. Now, what's the third mandate of the MTO? The third mandate of MTO is compliance monitoring. Monitoring compliance, to monitor compliance of the medium size entities. All right? Conducting compliance checks and audits that are appropriate for the size and complexity of medium taxpayers. 4. Taxpayer education. Taxpayer education and support. This office offers targeted education resources to help medium taxpayers understand their obligations and to also to utilize e-services like the iTax and maintain proper records. 5 is base expansion. Base expansion. Base expansion. The MTO contributes to the expansion of the tax base by ensuring compliance among this growing segment of businesses and so on. So these are 7 functions of the large taxpayers office and 6 functions of the medium taxpayers office. And the 2 are crucial for KRA's revenue mobilization strategy. The 2 allows the authority to deploy resources and expertise efficiently to manage the different taxpayer segments based on their revenue contribution and compliance complexity. So that is the end of the lesson and the end of the chapter on introduction to taxation. In this lesson, we covered the Kenya Revenue Authority. We looked at the structure. Under the structure, we said it comprises, the organization structure comprises of the board of directors. The board of directors, under is the CEO. Then we have key departments or divisions within KRA. The first one being Domestic Taxes Department, Customs and Border Control Department. Number 3, Investigations and Enforcement Department. Number 4, we have the Intelligence and Strategic Operations Department. Number 5, we have the Corporate Support Services Department. Number 6, Legal Services and Board Coordination Department. Number 7, Strategy, Innovation and Risk Management Department. And lastly, we have the Kenya School of Revenue Administration. Then lastly, we have regional divisions. We have regional divisions within KRA. Then we've also analyzed the functions of the Kenya Revenue Authority. One is the revenue assessment, collection, and accounting. Number 2, the authority has an administrative role. Number 3, trade facilitation. Number 4, border control. Number 5, taxpayer services and education. Number 6, we have enforcement and compliance. Number 7, dispute resolution. 8, data management and analysis. Then lastly, we've studied the large and medium. The next one is the large taxpayers. This is the large taxpayers office. The mandate, we have outlined the mandate. Then we also have outlined the mandate of the medium taxpayers office. And that will be the end of the lesson. Bye-bye. Hello and welcome back to the lesson. I'm here one more time to continue with the lessons in taxation. Today we still focus on value-added tax, and we are going to focus on value-added tax records. In this lesson, we will identify the key records that are required to be kept for VAT purposes, the VAT record. Then we look at the format. We'll also identify the period of retention of the records. And number 4, availability for inspection. We will, in this lesson, study the consistency and reconciliation of records. And lastly, the importance of keeping VAT records. We are going to capture those 4 areas in our, the 6 areas in our today's lesson. VAT records, value-added tax records, because candidates maintaining accurate and comprehensive VAT records is a statutory obligation for all VAT registered persons in Kenya. And these records are crucial for accurate and for facilitating efficient business operations. And the legal basis for keeping of VAT records is the Tax Procedures Act and the VAT Act, along with their respective regulations. So what are these records? What are these VAT records? Now, the first VAT record is the sales records. Sales records. Registered VAT persons are required to maintain sales records, and that involves copies of all e-TIMS generated tax invoices and simplified tax invoices, which are cash sales or receipts that are issued. And these invoices ought to be serially numbered. We may also have copies of serially numbered credit notes, serially numbered debit notes, and records of supplies to privileged persons or institutions showing reason for 0% VAT. You understand? The sales records. If you are doing business and you are a VAT registered person, you are first of all required to maintain sales records, which constitute copies of e-TIMS generated tax invoice. That is number one. We also have copies of serially numbered credit notes. Number three, we have serially numbered debit notes. Then we also have daily sales book or summaries of sales journals. Then, of course, number four, we have the records of supplies to privileged persons and institutions, showing why the sales to them are 0 rated. That is one category of record. Then we have two purchase records. Purchase records. These are original e-TIM generated tax invoices received for all taxable purchases, which are essential for claiming input tax. Purchase receipts are also to be kept, and order details. For example, the local purchase orders, the contracts, the tenders, and so on. Then we also have copies of customs entries and receipts for payment of import VAT. Under purchases records, one also need to have copies of credit notes and debit notes received from suppliers. We mentioned debit notes and credit notes that are issued to the vendors, but you also have the suppliers. The copies of debit notes and credit notes ought to be kept. So we have sales records, we have purchases records. Then number three, there are records related to cash. These are cash and bank records. Cash and bank records include the cash book, the petty cash book, the bank statements and reconciliations. We have pay slips or check counterfoils, the records of all payment transactions, whether by cash, by check, or electronic transfer. Any transactions related to cash or bank, those records are required to be maintained. The fourth category of records, we are identifying types of records for VAT purposes. Number four is imported services records. Imported services records. Imported services records. These are records for reverse charge. There ought to be evidence to identify the supplier and the recipient, also the nature and quantity of services supplied, the time and place of supply. We have the consideration of the supply and extent to which the supply has been used by recipient for a particular purpose. 5. Returns and accounts. This is another set of records that are required to be maintained. Returns and accounts. These are copies of all VAT3 returns filed monthly. These are monthly returns. Copies of monthly returns should be maintained. Copies of monthly returns. We have annual audited financial statements, including the income statement, the balance sheet, the cash flow statement. There is also the VAT refund claim copies, if applicable. Then another record is we withholding VAT tax certificates. If tax was withheld from your sales, then you need to have copies of withholding tax certificates. Then there are other records like the stock records. Other records include the stock records, that is inventory movement. They may also have details of all deliveries. We have VAT account for each tax period. We have any other accounts or records specified in writing by the Commission. So these are the types of records. Types of records. Then let's discuss briefly the format of records. Format of records. What format should these records take? Records can be maintained physically or electronically. For electronic records, one ought to ensure they are easily accessible, secure, and can be readily retrieved and printed, and also readily printable if required by KRA. We have originals of key documents like tax invoices that are crucial, and if originals are lost, one may be required to have certified copies clearly marked as such, and that may be accepted under specific circumstances. So that's the format. It can be physical or electronic. Physical means paper on hard copies. It could also be electronic. That's the format of tax records. How about period of retention? What is the period of retention? For how long should a VAT registered person maintain these records? For how long? What is the period of retention? Now, the Tax Procedures Act mandates taxpayers to retain all tax records, including VAT records, for a period of at least 5 years. At least 5 years. Not less than 5 years. At least 5 years from the last entry made or the end of the tax period to which they relate. Understand? Yes. Availability for inspection. This is 1, 2, 3, 4. Availability is important for you to understand. Availability for inspection. That is to mean that VAT registered persons must make their records available to authorized KRA officials for inspection upon request. These records must be made available to authorized Kenya Revenue Authority officials upon request. And the records should be organized. For example, chronologically by date or by suppliers or customers' name to facilitate easy inspection. These records, again, candidates, should be kept in Kenya and should either be in English or Kiswahili languages. You understand? The records should be available for inspection by KRA officials upon request. The records should be kept in such a way that it's easy to inspect. For example, having them organized chronologically. Another point in relation to VAT records is consistency and reconciliation. Consistency and reconciliation. Consistency and reconciliation. Records should be consistent across various financial documents. For example, sales declared in VAT returns should reconcile with audited financial statements, because inconsistencies can trigger audits and additional assessments. And therefore, regular reconciliations. You should regularly reconcile your income tax, VAT, and expense records in order to ensure alignment with financial statements. You understand? Then we have another important point. We're talking about consistency and reconciliation. This consistency should be in line with financial statements. It should be in line with financial statements, such that if the VAT records are not consistent with other records like financial statements, that can trigger additional assessments, can trigger audits, can trigger investigation, and therefore it's important to have regular reconciliations. You regularly reconcile the income tax, the expense records, and also VAT to ensure alignment with financial statements. Then we have the last important point here is E-Teams compliance. E-Teams compliance. Now, since 2021 August, all VAT registered taxpayers are required to use E-Teams. E-Teams means Electronic Tax Invoice Management System. Should use compliant devices to generate tax invoices. And these devices transmit invoice data to KRA in real time or near real time. So keeping details is a critical record keeping requirement. And if an E-Team device malfunctions, the taxpayer must report it to the service person and inform KRA in writing within 24 hours. All right? Yes. Now let's finally discuss the importance of keeping VAT records. What is the use? What is the importance of keeping accurate VAT records? One is for accurate tax returns. To facilitate accurate tax returns. Keeping VAT records ensures correct calculation of output tax, input tax, and net VAT liability. Another reason is that these records can be proof for input tax claims. Proof for input tax claims. Without valid records, especially proper tax invoices, input tax claims will be disallowed, leading to increased VAT payable. 3. Audit readiness. These records facilitate smooth KRA audits and reduces the likelihood of disputes, penalties, and additional assessments. Another importance or reason is burden. Is it burden of proof? Proof. Yes. Under the Tax Procedures Act, the burden of proving that a tax assessment is incorrect lies with the taxpayer. So without sufficient supporting documentation, it becomes difficult to challenge KRA's assessments. Then another obvious reason is for financial management. That is another reason why, if you are a VAT registered person, should maintain proper records, is for financial management. These records provides clear financial insights for business decision making, for tracking profitability, and even cash flows. 6. These records can help a registered taxpayer, VAT person, to avoid penalties. Avoidance of penalties. Failure to maintain proper records is an offense that attracts significant penalties. For example, we have 10% of tax payable, or even 100,000 shillings, whichever is higher. So that is all candidates for VAT records. In this lesson, we've identified the types of records. We've also seen that the format of VAT records should be in physical form or electronic form. The VAT records should also be maintained for at least 5 years. We've seen why these records can or should be made available for inspection by KRA officials. We've seen the importance of consistency and reconciliation, and E-Teams compliance. In this lesson, again, we've identified 6 reasons why keeping proper VAT records is critical, One is to account for tax returns. It may be used as proof for input tax claims. These records help the taxpayer be ready for audits. Okay, it is also the burden of proof lies with the VAT registered person. 5 is just for financial management and also avoidance of penalties. Thank you for attending the lesson. We will meet in our next session where we continue to learn more on value-added tax in Kenya. Bye. Hello and welcome to the lesson. The subject is taxation. Our today's lesson is centered around value of a supply. This is value for VAT. Okay, we are going in this lesson to highlight some of the general principles that apply when determining the value of a supply. And in the context of value-added tax in Kenya, the value of a supply is also known as the taxable value. The taxable value. The value of a supply is known as the taxable value. The taxable value, and it is the amount upon which VAT is calculated. It is the amount upon which VAT is calculated. It is the amount upon which VAT is calculated. So if a publisher is selling a book before VAT inclusive of 1,000 shillings, before application of VAT, then this 1,000 becomes the taxable value, or the amount upon which VAT is calculated. So we apply the 16% VAT. The VAT here will be 160 plus the taxable amount of 1,000. So the total will be 1160. So 1160 is the price inclusive of VAT. That the price before applying the VAT is what you are referring to as the value for VAT, or value of a supply, or taxable value, and it is the amount upon which VAT is calculated. All right, and it's crucial for VAT registered persons to correctly determine this value to ensure accurate charging of output tax and calculation of the overall VAT liability. You understand, candidates? Yes. So in this lesson, we want to see how this amount is arrived at. And the VAT Act and the VAT regulations in Kenya provide the framework for determining the value of a supply. So we want to identify a few general principles surrounding the value of VAT, value for VAT. The taxable value of a supply of goods or services is generally considered the consideration price paid or payable for the supply, excluding the VAT itself. And that means it's the net amount before VAT is added. So inclusions in the value of the supply would include like levies, duties, and so on. So we want to look at some of the inclusions in the value of a supply. What are the inclusions? Inclusions in the value. What does it contain? Value of a supply. What does this value contain? Now, number one, the consideration for a supply is broadly defined and includes the value of the supply. It includes the total amount charged for the supply. One, the total amount charged for the supply. It includes, number one, the total amount charged for the supply, and this supply could be a good or a service. This is the basic price of the goods or services. Then it may include any other charges, any other charges, levies, any other fees. It could be excise duty, import duty, and specific levies that may be included in the taxable value before VAT is calculated. Import duty, export duty, etc. So you have, first of all, the total amount charged for the supply. Then there could be other charges or levies that are included in that price. It could be the import duty, export duty, and other charges. These are calculated in the taxable value before VAT is calculated. There could also be incidental costs. Incidental costs are also included in this value. Any costs incurred by the supplier in providing the goods or services that are charged to the customer, for example, packaging, transport, insurance, are generally part of the value of the supply. 4, we have payments in kind. Payments in kind or non-monetary consideration. Payment in kind or non-monetary consideration. This may also be included in the value for VAT or value of a supply. If the consideration is not purely monetary, the open market value of the non-monetary consideration is also included in the taxable amount. You understand? We may also have 5 subsidies. Subsidies directly linked to the price of the supply. Subsidies directly linked to the price of the supply. How are subsidies treated? Now, if a subsidy is given to the supplier and the subsidy directly reduces the price charged to the customer, it may be included in the taxable value. It does not reduce, but it's included. So subsidies are included in the taxable value, in the value of a supply. You understand? And candidates, there are also some special considerations when it comes to determining the taxable value or the value of a supply. We have special considerations, some of which I've mentioned. Special considerations in relation to the value of a supply. We have the open market value. This is where the supplier and the recipient of a supply are related parties. Okay, open market value. For related parties, open market value. There is the open market value. And here we are talking about where the supplier and the recipient of the supply are related parties. For example, companies within the same group or individuals with close family ties. The commissioner may determine the value of the supply to be its open market value. And the open market value is defined as the consideration that a supplier would reasonably be expected to fetch in an arm's length transaction. That is to mean a transaction between independent parties made at the time of the supply. And this is to prevent artificial manipulation of prices to reduce VAT liability. Another special consideration is self-supplies. Now, if a VAT registered person applies taxable goods or services for use outside their business, this is generally treated as a taxable supply. So the taxable value in such cases is consideration paid or payable for the acquisition of the stock, or even the open market value of the goods or services at the time of the supply, whichever is higher. And that ensures that input tax claim on such goods or services is effectively accounted for. Self-supplies. What of imported goods? This is another special consideration. Imported goods. Now, for imported goods, the taxable value for VAT purposes is the sum of the customs value of the goods as determined for customs duty importation. It may also be the freight and insurance costs which are incurred to bring the goods into Kenya, and any incidental or auxiliary services associated with the importation. So if you are to calculate the value of a supply of imported goods, then you have to include the customs duties, the excise duties, and other levies paid on the importation, including freight and insurance costs. Then we have import services. Imported services. We have imported goods and imported services, what we call the reverse charge. For imported taxable services, where the recipient in Kenya is a VAT registered person, they are generally required to account for VAT under the reverse charge mechanism. And this taxable value is the consideration paid or payable for the imported services. Special consideration number 5, we are discussing value of a supply is supplies by auctioneers or agents. Supplies by auctioneers or agents. Supplies by auctioneers or agents. The value of a supply made by an auctioneer or agent on behalf of another person is generally the amount for which the goods or services are sold. You understand? Yes. So these are special considerations in regard to value of a supply. Now, before we close the lesson, let us address the issue of exemptions or exclusions from value of a supply. That is to mean, what are the items that generally are not included in the taxable income? Exclusions from value of a supply. Exclusions from value of a supply. What costs or what is excluded from the value of a supply? Here, we've identified what is included in the value of a supply. So we want to highlight what is the items generally not included in the taxable value. Because while most charges related to a supply are included, there are some specific items that are explicitly excluded from the consideration for VAT purposes. One such item is output VAT itself. Output VAT itself. Output VAT itself. VAT is calculated on the value of a supply. So VAT calculated on the value of a supply is not part of the value of a supply, because the value is the net price. 2, financial charges for goods sold on credit. For goods sold on credit. Financial charges for goods sold on credit. Now, this typically refers to interest or financing fees charged for deferred payments separate from the core price of the goods. That is also excluded from the value of a supply. Interest for late payment, number 3. Interest for late payment. Interest for late payment. Interest for late payment. These are penalties or interest charged for overdue payments by the customer. These are generally not subject to VAT. So the interest that is paid, for example, if one defaults on undischarged interest, that interest is not subject to VAT. It's an exclusion. Interest for late payment. Interest for late payment. Then you have tourism levy, number 4. Tourism levy. Tourism levy. Tourism levy. Now, the tourism levy, where applicable, is a separate charge and typically not included in the taxable value. You understand? It is a separate levy and it's not included. It is not included. It is not included in the value of a supply. It is not included, in other words, in the vatable value. The taxable value for VAT purposes is the vatable value. This is also known as the vatable value. Taxable value, value of a supply, vatable value is the same thing, and tourism levy is not part of it. Then you have service charge in lieu of tips. Service charge in lieu of tips. Service charge in lieu of tips in hotels and restaurants. Now, under specific conditions, for example, where there is an agreement in place and the service charge is less than 10% of the bill, this amount may be excluded from the taxable value. We can also cite number 6, discounts. Discounts are exclusions from the value of a supply. Discounts. This is bona fide trade discounts offered at the time of a supply. They generally reduce the taxable value. So these are 6 exclusions from the VATable value. And that will mark the end of this lesson on value of a supply, or value for VAT, which we've defined as the taxable value or the VATable value. We've said it is the amount upon which VAT is calculated. We've outlined the general principles that guide in the determination of the VATable value. The first principle is that the total amount charged for the supply is the starting point, the total amount charged for the supply. Then we add any other charges or levies like import duties, like export duties and other levies. There could also be incidental costs associated with the supply, like insurance, transportation, and so on. Then number 4, we have payment in kind. This is payment in kind, or non-monetary consideration is also part of the VATable value. Then subsidies directly linked to the price of a supply must also be included in the VATable value. We've also explained candidates some special considerations in relation to open market value, the self-supplies, imported goods. We also have imported services and supplies by auctioneers or agents. Then lastly, we've highlighted the exclusions from value of a supply. One is the output VAT itself. Number 2, we have financial charges for goods sold on credit. Number 3, interest for late payment is excluded. The tourism levy is excluded. The service charge in lieu of tips in hotels and restaurants, this is excluded, and discounts. So candidates, is very important to determine the correct value of a supply. Now, if you are to be asked, what is the importance of determining the correct value of a supply, what would you answer? Let's answer that question before we close. Importance. What is the importance? Why is it important to determine the accurate value of a VATable value? Why is it important? The first one is so as to calculate accurately the output tax. It is for accurate output tax calculation. Accurate output tax calculation. Accurate output tax calculation. The VATable value has to be accurate so that we can arrive at an accurate output tax calculation. It ensures the correct amount of VAT is charged to customers. It also gives rise to correct VAT liability. If the VATable value or the value of a supply is accurate, then the VAT liability will also be correct. It impacts the total VAT due to KRA. The third obvious reason is for the purposes of compliance. Compliance, for compliance purposes. Accurately determining the VATable value avoids penalties and interest for claims by the recipient if the invoice does not, it avoids penalties and interest for under declaration or even miscalculation of VAT. Compliance. Then another reason why this calculation is important is just for input tax claims. Input tax claims. Because sometimes it's important, it may be necessary to apply for claims, input tax claims. So the taxable value affects the validity of input tax claims by the recipient if the invoice does not reflect the correct taxable value. So that is all, candidates, for today's lesson, which is the value of a supply or value for VAT. And we've said at the beginning that in the context of value-added tax in Kenya, the value of a supply is also known as the taxable value or the VATable value, and it is the amount upon which VAT is calculated. Thank you. God bless you. Bye-bye. Hello, I'm back to continue with the subject elements of taxation. The topic is value-added tax. Today we're going to discuss three things. One is remission of VAT. Number two, rebate of VAT. And three, refund of VAT. Three areas. And in Kenya, refund, rebate, and remission all refer to ways in which VAT that has been charged or paid is returned to a taxpayer, but they apply in different circumstances. These terms apply in different circumstances, but generally, these three, rebate, remission, and refund, refers to ways in which VAT that has been charged is returned to the taxpayer. The three refers to ways in which VAT that has been charged is returned to the taxpayer. But the three are used in different circumstances. Refers to ways in which VAT that has been charged is returned to the taxpayer. But they apply in different circumstances and have distinct legal bases and processes. So the idea is the same, returning VAT that has been charged to the taxpayer. So returning VAT that has been charged to the taxpayer can be done through remission, rebate, or refund. Remission, rebate, or refund. Let's first define remission. Remission of VAT. Now, remission of tax means the waiver or cancellation of a tax liability. It means waiver or cancellation. Waiver or cancellation of a tax liability. Waiver refers to, remission refers to waiver or cancellation of a tax liability that would otherwise be due, or it may refer to the waiver of VAT on certain imports or supplies from the outset, and is often granted before the tax is actually paid. Remission is granted before the tax is actually paid. It is granted before the VAT tax is actually paid. Before VAT is actually paid. Or we can say it negates the need for payment. A remission negates the need for payment because the liability has been cancelled. The taxpayer is no longer required to meet this liability. It negates the need for payment. And it's typically applied for specific purposes or for certain categories of goods or services. You understand? Yes. So what are some of the characteristics of remission? Now, in discussing characteristics, we are going to identify key areas like prospective application. One, prospective application. Remission is usually granted before the tax liability arises or before the goods are imported or supplied, and you apply for it in advance. That's why we are calling it prospective application. Remission has to be applied for in advance, then so that the tax liability is negated. The second characteristic of remission is in relation to the specific legal provision. Specific legal provision. Remission is not a general right, but is granted under specific provisions of the VAT Act or other legislation, often through gazette notices or agreements. 3. Aid-funded projects. Aid-funded projects. A common area for VAT remission is on taxable services, materials, and equipment used in aid-funded projects that is carried out pursuant to agreements between the government of Kenya and foreign governments or organizations. And the agreements must expressly provide for such remissions. Aid-funded projects. Then in discussing the characteristics of remission, we need to say something about investments. Investments. Historically, there have been provisions for VAT remission for certain large-scale investments, although the specific criteria and eligibility for these areas can change with finance acts. Then there is another aspect of remission, which is conditions. Now, remission is always subject to strict conditions regarding the use or disposal of the goods or services. And if these conditions are breached, then the remitted tax becomes payable. Then the remitted tax or the waived tax or the cancelled tax becomes payable if conditions are breached. Then lastly, of course, let's discuss something briefly about the process. Now, an application for remission typically needs to be made to the Cabinet Secretary for National Treasury or the Commissioner, often with detailed list of goods and feasibility study for investments. And the approved application is then delivered to KRS Customs and Domestic Taxes Department for verification. Now, a good example of a remission is a non-governmental organization carrying out a specific humanitarian project funded by a foreign government that may have an agreement that provides for a remission of VAT on materials and equipment imported for that project. So they would apply for this remission in advance, and if approved, they would not pay VAT at the point of importation or at the point of acquisition. That's a good example of remission candidates. So that's all for remission. Let's briefly discuss rebate. Now, rebate of VAT. This is remission of VAT. Rebate of VAT, value added tax. Now, the term rebate in the context of Kenya's VAT is less commonly used as a distinct statutory mechanism compared to remission or refund. And in general tax parlance, a rebate usually refers to a partial refund or reduction in amount due. It is a partial refund or reduction in amount due. It's refund or reduction in amount due. For example, if the VAT liability is 1 million, a rebate of 100,000 may be granted, which is a reduction of the 1 million. And sometimes rebate might be used informally to describe a situation where certain industries or types of businesses benefit from a reduction in their overall tax burden through other means, such as accelerated depreciation allowances or specific zero rating provisions. But historically, there might have been specific regulations or policies that used the term rebate. But the current VAT Act of 2013 predominantly uses remission and refund. Predominantly, the VAT Act uses the term remission and refund of VAT. And essentially, if a rebate were to occur, it would likely fall under the broader categories of specific exemptions, or zero rating, or a refund mechanism outlined in the law. So there's not much to discuss about rebate of VAT, because this term is not predominant in the VAT Act. Then moving on to refund of VAT. Refund of VAT. Refund of VAT. Now, what is refund of VAT? Now, a VAT refund is the reimbursement of excess input tax. It is the reimbursement of VAT input tax. To refund is to reimburse, or a tax paid in error to a VAT registered person by KRA. It is a refund of tax paid in error, or just a refund of excess input tax. And this occurs when the amount of input tax legitimately occurred, which legitimately occurred exceeds the output tax charged during a given period, or when VAT has been incorrectly calculated. Reimbursement. Refund of VAT is just the reimbursement of VAT input tax. So what are the characteristics? Characteristics of VAT refund. Characteristics. What are the characteristics? Characteristics and types. Characteristics. Now, candidates, one characteristic of refund of VAT is that excess input tax. Excess input tax. I've defined it here. Excess input tax is one characteristic of refund of VAT. This is the most frequent type of VAT refund. It arises when VAT registered person's input tax exceeds their output tax for a tax period. And this typically happens in case of zero-rated supplies. Because since no output VAT is collected, but input VAT is incurred. So a credit accumulates, and it also occurs when VAT is withheld by appointed withholding VAT agents. So the amount withheld is a credit, and if it is combined with other input tax, exceeds output tax, and a refund position arises. Number 2, paid in error. Tax paid in error. Tax paid in error. This occurs when a taxpayer has erroneously paid VAT that was not due. And that could be because of a miscalculation or payment to the wrong PIN. And it may be payment also for an exempt supply. So the claim for tax paid is in error generally must be made within 12 months from the date of payment. The claim for tax paid in error must be made within 12 months from the date of payment. Then there is VAT on bad debts. VAT on bad debts. VAT on bad debts. A VAT registered person who has supplied goods or services, accounted for and paid VAT on that supply, but has not received payment from the customer, can apply for a refund of the VAT component. But of course, that comes with certain conditions. And one condition is that the claim can be made after 3 years from the date the supply was made. Another condition is that the claim must be made within 5 years from the date of the supply. Another condition, the taxpayer must prove that all reasonable steps have taken place to recover the debt. And finally, an application is also allowed if the customer has been declared insolvent or placed under statutory management. So if the refund is granted and the taxpayer later on recovers part or all the debt, the VAT portion must be repaid to the Kenya Revenue Authority. Then another characteristic of refund of VAT is capital goods. Capital. We must say something about the capital goods or investment refunds. Capital goods to investment refunds. Now, while not a distinct type of refund, businesses making significant capital investments where a large amount of input tax is incurred before substantial output VAT is generated may find themselves in a refund position. So these are the types of refund of VAT. The types. One, we have excess input tax. Where we have excess input tax, that can necessitate refund of VAT. There is also tax paid in error. VAT paid in error can also lead to refund of VAT. Then there is VAT on bad debts, where someone business applies to debtor and the debtor fails to pay. That can be the VAT that is incurred there can also be refunded, but there are certain strict conditions that must be met before that refund request is granted. Then lastly, we have capital goods or investment refunds. So that's all candidates for remission, rebate, and refund of VAT. And of course, VAT refund process, you all know, can be just done on the iTax platform, KRS iTax platform. The taxpayer must file their monthly VAT3 return via iTax, clearly indicating the VAT refund amount. Then the taxpayer can lodge a form of VAT refund application on the iTax platform, selecting the refund type and providing details. Of course, the taxpayer has also to provide supporting documentations. That may be required to attach all necessary supporting documents, including valid eTIMS tax invoices for all input claims, export documentation for zero-rated exports, withholding tax certificates, and so on. After that is done, after filing and applying and attaching the supporting documents, then KRA processes and verifies the application. KRA will review the application, and that has to be done within a time frame of 90 days. Then the Tax Procedures Act, we also know, states that KRA shall ascertain and determine any application within 90 days. And first-time claimants or high-value claims may be subjected to a prepayment audit or verification. Then lastly, if KRA fails to process an approved refund within 6 months, the taxpayer can apply to offset the refund against other outstanding tax liabilities, like income tax, like payee, or even future tax liabilities. But if approved, then the refund is paid to the taxpayer's bank account or used to offset other tax debts or liabilities. So that's the process of applying for refunds in Kenya. But there are also challenges with refunds. In Kenya, candidates historically, VAT refunds have been a significant point of contention between taxpayers and KRA, with delays impacting business cash flows, especially exporters. And while KRA has made efforts to streamline processes, delays can still occur due to budgetary constraints at KRA for refund disbursement. Delays can also occur due to audit queries and verification processes. Delays can occur due to discrepancies in records or documentations, and so on. So that's all for remission, rebate and refund of VAT. And it's important for you to remember, we've said that while remission and rebate refer to specific forms of tax relief, the refund mechanism is the most common way for VAT registered businesses to recover excess VAT credits, particularly those engaged in zero-rated supplies or those subjected to withholding VAT. That's all. Thank you for attending the lesson. The lesson has been on remission, rebate, and refund of VAT. Bye. Greetings and welcome back. We are continuing with our studies in taxation. The topic is value-added tax. Today we are going to discuss the types of supplies in the context of VAT in Kenya, because understanding the different types of supplies is fundamental, because that then determines whether VAT should be charged. It also determines at what rate the VAT will be charged and what implications it has for claiming input tax. So the VAT Act of 2013 categorizes supplies into three main types. One is standard rated supplies. We have the zero rated supplies and exempt supplies. So we're going to try and understand all these types of taxes, beginning with the standard rated supplies. There are three main types. One is standard rated supplies. Standard rated supplies candidates are goods and services on which VAT is charged at the standard rate that is prescribed by law. So standard rated supplies refer to goods and services. It refers to number one, goods and services on which VAT is charged at the standard rate. So supplies are goods or services, and standard rate supplies then will refer to goods and services on which VAT is charged at the standard rate that is prescribed by law. And the current standard rate in Kenya is 16%. We are doing this recording in the year 2025. So in the year 2025, the VAT standard rate is 16%. Now, what are the characteristics of these supplies? Characteristics. This is the definition of standard rated supplies. What are the characteristics? What are the key characteristics? Number one, VAT is charged. These are supplies on which VAT is charged. You understand? The supplier must add 16% VAT on or to the price of the goods or services and then collect it from the customer. So if MP, Manifested Publishers, is selling books at 1,500 Kenya shillings, if this is the cost or the market price, exclusive of tax, then Manifested Publishers has to add a 1.16 on these goods, and this will be around 1740. You understand? The supplier must add 16%. So 16% is added to the 1,500 to arrive at a VAT inclusive invoice price. Then the company, the VAT registered person, will then collect this VAT from the customer, because when the customer buys this book, it is inclusive of VAT. So this seller would collect this VAT from the customers. That's the first characteristic of these standard rated supplies. VAT is charged on these supplies. VAT is charged on these supplies. That's the first characteristic. The second characteristic is input tax is recoverable. 2. Input tax is recoverable. What does that mean? When we say input tax is recoverable. Now, a VAT registered person making standard rated supplies can claim deduction for the input tax they incurred on purchases and expenses that were used in producing these supplies. You understand? And that is the essence of VAT. A VAT registered person, I'm repeating, making or selling standard rated supplies can claim a deduction for the input tax they incurred on purchases and expenses used to make the supplies. And that is the core mechanism of VAT, where the tax burden is passed on to the final consumer. So if we have, let me use the example I gave, we have manifested publishers that is selling books, VAT inclusive, the price is 1740 per book. These are shillings. In publishing or printing this book, manifested incurred some costs, what we are calling input. A VAT registered person making standard rated goods or services can claim deduction for the input tax they incurred. So when manifested bought papers to publish these books, the price was inclusive of VAT. Maybe a ream of 1,000 shillings inclusive of VAT, of say 1,600. Because 16% of 1,000, if the cost of a ream is 1,000 and the VAT is 16%, then the input price here, the cost and VAT inclusive, the VAT will be 600 shillings. So manifested buys this paper at 1,600 VAT inclusive. So we're saying here that manifested publishers that is selling standard rated supplies, books, at 1740 VAT inclusive can recover input tax that was paid by manifested publishers when buying this paper. This paper is an input. We have other services, expenses, candidates. These are supplies and services and expenses. So a VAT registered person making standard rated supplies can claim a deduction for the input tax that they incurred on purchases and expenses used to make these supplies. And that is the core mechanism of VAT, where the tax burden is passed on to the final consumer. So here manifested paid VAT on this input supplies. Then that VAT of 16% manifested has to recover it from the final consumer. It is the final consumer who finally pays the VAT. That's why VAT is sometimes referred to as a consumer tax. You understand? That's the second characteristic of standard rated supplies. Another characteristic is output tax. The output tax sometimes can be greater than the input, should be greater than the input. The output tax should be greater than the input tax. Generally, for businesses dealing with predominantly standard rated supplies, the output tax, which is the VAT collected, will be greater than their input tax, which is the VAT paid. The VAT paid when buying the papers by manifested publishers, when you compare with the output tax, we are saying that the output tax will be greater than their input tax, which is the VAT paid, resulting in a net payment to KRA. So output tax should be greater than the input tax. Then if that then happens, the VAT registered person is required to pay. There will be a money that will be remitted to KRA because the output tax is greater than the input tax. But if the input tax is greater than the output tax, then there is no money that will be paid to the government. It is the government now to refund the registered tax agent. So these are three core characteristics of standard rated supplies. And the examples of standard rated supplies include most manufactured goods, furniture, electronics, clothing. Most manufactured goods attract this standard rated tax of 16%. So one example I'm giving is the manufactured goods like electronics, furniture, clothing, and so on. Then we have restaurant and hotel services. Of course, there could be some specific exempt items. Professional services also attract those providing professional services like accounting, law. They are required also to pay VAT, excluding we have examples are legal services, accounting professional services, consulting, architectural, engineering, and so on. Telecommunication services is also another example of standard rated services or supplies. Telecommunication services. We also have electricity for commercial use, fuel, petrol, diesel, motor vehicles. All those attract VAT. You understand? So that is one type of supply, standard rated supplies. Then the second one is the zero rated supplies. Zero rated supplies are taxable supplies on which VAT is charged at the rate of 0%. These supplies VAT is charged at the rate of 0%. VAT is charged at the rate of 0%. Now, while the rate is 0, they are still considered taxable supplies. The rate is 0, but they are also still considered as taxable supplies. Characteristics. These are zero rated supplies. What are the characteristics? Let me move to page 2. Characteristics of zero rated supplies. Now, the first characteristic is that VAT is charged at 0%. 1. VAT is charged at 0%. VAT is charged at 0%. The supplier does not collect any VAT from the customer on these supplies. Then number 2, the input tax is recoverable. Input tax is recoverable. Input tax is recoverable. You understand? First of all, the supplier does not collect any VAT from the customer on these supplies. Number 2, input tax is recoverable. Despite charging 0% VAT, a VAT registered person making zero-rated supplies can still claim a deduction for the input tax they incurred on purchases and expenses related to making these supplies. And because of that, they often lead to refunds. It often results in refund. Zero-rated supplies often results in refunds. Because no output tax is collected, but input tax is recoverable, Businesses predominantly making zero-rated supplies often find themselves in a VAT refund position. This is where input tax exceeds output tax, meaning that KRA owes them money. Or policy objective. There is a characteristic related to policy. Zero rating is often used to make certain goods or services more competitive. For example, exports, or even to reduce the tax burden on essential services or goods, because the final consumer does not pay VAT. You understand? It's a policy decision. Now, currently, examples of zero-rated supplies subject to changes in Finance Acts would be things like exports on goods or services, like goods exported from Kenya or services supplied to a person outside Kenya, excluding certain services like financial services. And that's the most common example of zero rating globally. Exports of goods or services. We also have certain agricultural supplies. We have specific and processed agricultural products as listed in the law. We also have supplies to export processing zones and special economic zones. Goods and services supplied to licensed EPZ enterprises or supplies to export processing zones within Kenya. Those are zero-rated supplies. Another example is the international transport services. Transport of passengers and goods by road or air outside Kenya. There could be also certain goods that are used in exploration and production of oil, production of gas, or mining. You understand? Yes. Those are examples of zero-rated supplies. Examples of zero-rated supplies. Examples of zero-rated supplies. Candidates, we are discussing types of supplies. We are discussing types of supplies. Types of supplies. Then we have the third type of supplies is what we call the exempt supplies. Exempt supplies. C. Exempt supplies. Now, what are these exempt supplies? These are goods and services that are not subject to VAT at all. Are not subject. These are supplies that are not subject to VAT at all. Exempt. They are outside the scope of VAT and no VAT is charged on their supply. What are the characteristics? Characteristics. What are the characteristics of these supplies? Number one, no VAT is charged. One, no VAT is charged. No VAT is charged. The supplier does not add or collect VAT on these supplies. Two, input tax is not recoverable. Input tax is not recoverable. A VAT registered person making exempt supplies cannot claim a deduction for input tax incurred on purchases and expenses used to make these supplies. And therefore, the input tax paid on inputs for exempt supplies becomes a cost to the business. It therefore becomes a cost. That may also imply that there is no VAT implication. No VAT. There is no VAT implication. For businesses dealing only in exempt supplies, they are generally not required to register for VAT, regardless of their turnover. And of course, there is also a cascading effect of exempt supplies. What does that mean? It means that because input tax cannot be claimed, VAT on inputs for exempt supplies effectively becomes part of the cost, which can lead to cascading or a compounding effect of tax, as tax is hidden within the cost. So these are three characteristics. Examples of exempt supplies in Kenya: we have financial services such as banking services, insurance services, except for certain specific services like fund management or other consulting services. We have educational services. These are services provided by education institutions like schools, universities, colleges, and so on. We may also have medical and veterinary services. These are services provided by hospitals, clinics, doctors, and veterinary practitioners. Another example is public transport of passengers, buses, matatus, trains, domestic air travel, and so on. Those are services that are exempt for VAT purposes. Residential rental income. This is income from the lease of residential property. That's another example. Transfer of land and buildings. This is the sale of land and buildings other than new commercial buildings or certain specific developments. Those also are exempt goods and services. Burial and cremation services are also exempt supplies. Postal services, exempt, and so on. So these are the three types of supplies for VAT purposes. Three types: standard rated supplies. Number 2, zero rated supplies. Number 3, exempt supplies. So knowing this distinction is very critical, is very important. It's important to understand the classification of supplies because of various reasons. And candidates, why do you think the classification of supplies is crucial for VAT? If you are to be asked, why is the distinction of supplies crucial? The obvious answer one could be VAT registration. This classification determines if a business needs to register for VAT. Just as we have seen here, no VAT implication. Companies that are dealing with the predominantly exempt supplies are not required to register for VAT purposes. So if you are dealing with goods, it's important for you to know if the goods are standard rated, if the services are zero rated, or if they are exempt. That will help you make a decision as to whether to register for VAT or not. That's one reason to understand the classification. Another reason is the input or even just pricing. Before you get to the input tax recovery, we have the pricing. After how do we explain pricing? Pricing, we can say the pricing affects, okay? The classification affects the pricing strategy of goods or services. Another reason is for input tax recovery. This classification determines whether a business can claim back VAT on its purchases. There is also the aspect of VAT returns. It ensures that there is correct declaration of output and input tax in VAT returns. So businesses in Kenya must accurately identify the types of supplies they make to ensure compliance with VAT laws and avoid penalties. So that's why here we are studying the types of supplies. As an accountant, you need to understand the various classification of supplies for VAT purposes. Thank you for attending the lesson. In our next session, we are going to study the VAT rates, and we'll also work out some computations regarding VAT. Bye-bye. Hello candidates, and welcome back to the lesson. The subject is taxation, and the topic is value-added tax Today we are going to discuss the changes that must be notified to the Commission in regard to VAT. Changes that must be notified to the Commission. And therefore, candidates, by the end of this lesson, you should be able to outline the changes that must be notified to the Commissioner in relation to value-added tax. And here in Kenya, the Tax Procedures Act of 2015 is the primary legislation that governs the administration of taxes, including value-added tax. And it outlines the taxpayers' obligations to notify the Commissioner of Kenya Revenue Authority of certain changes. And these notifications are crucial for maintaining an accurate taxpayer register and also ensuring effective tax administration. And it's important to indicate that failure to notify the Commissioner of KRA of these changes within the stipulated timeframes can lead to penalties. Failure to do what? Failure to notify the Commissioner of Kenya Revenue Authority of changes in regard to value-added tax. So the question now is, what are these changes that must be notified to the Commissioner in relation to value-added tax? The first change is in relation to the PIN. Changes in PIN, changes in personal identification number details. Changes in personal identification number details. These are changes related to the initial registration. So changes in personal identification number details covers a broad range of changes related to the initial registration details. And this may include change of names. One, change of name, the name of the taxpayer. Change of name. Change of name. When a taxpayer or a registered VAT person changes a name, then that has to be notified to the Commissioner of KRA. For individuals, this would be a legal name change, and for companies, it would be a change in the registered company name. Changes in registered company name. Another example is in relation to the PIN details is change in address. Change of address. Change of address. For the change of address candidates includes physical address, it includes postal address, it may include email address, it may also include phone number. So the KRA uses this official communication candidates, the phone number, the email, the physical address. KRA uses all these details to communicate to the taxpayer. So if there's any change in the address, then it's important that the taxpayer notifies the Then the next change in relation to the PIN details is change in business location. Change in business location. Change in business location. Change in business location. If a business moves its premises, then that change has to be communicated to the Commission. Number 3 or 4 is change in residency status. Change in residency status. Change in residency status. Change in residency status. For individuals, if their tax residence changes, then that has to be notified to the Commissioner. 5, change in directorship or partnership. Change in directorship or partnerships. For companies or partners, changes in the individual holdings key positions should also be notified to the Commission. If there are any changes in the individuals holding key positions, if individuals, directors are holding key position, then such changes have to be communicated to the Commissioner of KRA. Then, of course, we need to mention something in relation to these PIN details, the timelines. What are the timelines? Now, generally, these changes should be updated on the iTax system within 21 days of the change occurring, and KRA often conducts data cleanup exercises and urges taxpayers to proactively update their details. So these are changes in relation to the initial PIN details. If there are changes to the initial PIN details, then such changes have to be notified to the Commissioner within a period of 21 days after the change has occurred. Then number 2 is cessation of business or trade. Cessation of business or trade. Cessation of business or trade. If a business ceases its operations or sells its business or goes into liquidation, that has to be notified to the Commissioner. That is the change of business or trade. The change of business or trade. And with that change, candidates, there is also implications for VAT. If a VAT registered person ceases to make taxable supplies or their taxable turnover falls below the prescribed threshold of 5 million for continuous period, then they are obligated to apply for deregistration from VAT. They are required to apply for deregistration from VAT. You understand? And what are the timelines? Here, the application for deregistration should be made promptly upon cessation or qualifying for deregistration, and certainly before winding up operations. So those are the timelines. The application for deregistration should be made promptly. So cessation of business has to be communicated to the Commissioner. That is the second type of change. 3, death of taxpayer. Death of a taxpayer. Death of a taxpayer, that is for individuals. Now, the death of an individual taxpayer necessitates notifying the Commissioner of KRA. If the taxpayer pays, then that has to be communicated to the Commissioner. The death of a taxpayer. And the legal representative or executor or administrator of the deceased estate is responsible for notifying KRA and settling any outstanding tax obligations. So when one dies, there is that administrator or the caretaker who is required to notify the KRA of the death of the taxpayer in regard to VAT. Death of a taxpayer has to be notified to the Commissioner of KRA. 4, appointment or change of a tax representative. Appointment or change of a tax representative should also be notified with the Commissioner. If a taxpayer appoints a tax representative, e.g. a tax agent, or changes the existing representative, then the taxpayer has to inform the Commissioner. Appointment or change of a tax representative, that is the 4th change. Then number 4 is change in payment details. Change in payment details, and these are details in tax. Change in payment details for withholding tax agents. Change in payment details, that is if applicable. And while not a direct change to PIN details, withholding tax agents, including withholding VAT agents, are responsible for correctly remitting withheld taxes, and any changes that impact the ability to do so or require cancellation of withholding certificates, then they have to notify the KRA. They may require to notify KRA. So these are candidates that must be notified to the Commissioner of KRA. Changes in PIN details. These are the initial registration details. If there are any changes later on, for example, change of name, change of address, change in business location, residency status, change in directorships or partnerships, then that has to be notified to the Commissioner of KRA. The second category is cessation of business or trade. Number 4 is the death of a taxpayer. Then there is appointment or changes of tax representatives. Then lastly, change in payment details for withholding agents. And candidates' failure to notify the Commission of changes in particulars within the stipulated time frame can lead to administrative penalties as per the Tax Procedures Act of 2015. If the notification is also not done, the KRA records may become inaccurate, leading to misdirected communication, leading to incorrect assessments, or even issues with tax compliance certificates. And being out of compliance with basic registration details can flag a taxpayer for further scrutiny by Kenya Revenue Authority. Again, another consequence of non-notification is difficulty in tax administration. It can hinder a taxpayer's ability to assess services on iTax or to receive important tax-related communications. So that's all for today's lesson, where we have highlighted the changes that must be notified to the Kenya Revenue Authority in relation to the VAT, Value Added Tax. Bye-bye. Greetings, candidates, and welcome to the Manifested e-learning platform. I'm glad to have you once again on the platform. Today we continue with our studies in taxation. The topic is value-added tax. Today's focus is on privileged persons and institutions. Privileged persons and institutions. Here in Kenya, there are certain privileged persons and institutions who are accorded special VAT treatment, primarily through rating of supplies made to them or their imports. And what that means is that the goods or services that they acquire are generally taxable, all right? These zero-rated services and goods means that while the goods and services that they acquire are generally taxable, the VAT rate applied to them is 0%, effectively making them VAT-free for these activities. So that is different from exempt supplies. It's important for you to differentiate the zero-rated supplies and the exempt supplies where the input VAT cannot be recovered. So under the Kenya laws, there are certain privileged persons and institutions who are accorded special VAT treatment. Do you understand? And the provisions of these privileged entities are primarily found in the second schedule, part 2 of the VAT Act of 2013. Do you understand? Titled Zero-rated supplies to public bodies, privileged persons and institutions. So the second schedule, part B of the VAT Act is titled Zero-rated supplies to public bodies, privileged persons and institutions. And one may ask, or you may be asked, what is the rationale behind according special VAT treatment to certain persons and institutions? Why is it that certain persons and institutions are accorded special VAT treatment through zero rating of their supplies made to them or their imports? What is the rationale? What is the rationale behind rationale? What are the reasons why the law accords certain persons and institutions special VAT treatment. Now, the first reason is diplomatic reciprocity. Diplomatic reciprocity. Diplomatic reciprocity. That is to mean the zero rating of supplies to these bodies facilitates the operations of foreign missions and international organizations in line with international conventions. Diplomatic reciprocity, to reciprocate. Because when Kenyan diplomats also go to other countries, they may also be accorded special VAT treatment. The second rationale is supporting humanitarian efforts. To support humanitarian and development efforts. To support humanitarian and development efforts. This means to reduce the cost burden on organizations that are involved in humanitarian aid, relief, and development. The third rationale or reason why certain individuals are accorded is government functions. Government functions. That's the third point. Government functions. That is to say that these bodies help in the streamlining of tax administration for certain public bodies, to streamline tax administration for certain public bodies. The reason why certain persons are accorded this special treatment is to streamline tax administration, to streamline tax administration. Now let's now move into the categories. What are the main categories of privileged persons and institutions? Main categories. And candidates, the rationale gives you a hint on the main categories of privileged persons and institutions. Okay, the first category is diplomatic missions. Diplomatic missions, number one. Diplomatic missions. We have consulates. Diplomatic missions. We have consulates and diplomatic agents. Diplomatic missions include the foreign embassies. These are just foreign embassies, consulates, and their agents. Then, as part of the first category, we have diplomatic agents. Diplomatic agents. So we have diplomatic agents and their personnel. Diplomatic agents and their personnel. Now, candidates, the first group is foreign embassies. Foreign embassies, consulates, and so on. So all taxable supplies, which include goods or services, for these bodies are zero rated. And this is a significant provision because it means that local suppliers issuing invoices to these foreign embassies and diplomatic agents and their personnel, all the supplies, all the invoices are zero rated. They are charged at 0% VAT. All the services, all the goods that are supplied to these bodies, the foreign embassies, they are zero rated. Then you have diplomatic agents and their personnel. Here we are talking about even the household and personal effects, including motor vehicles imported or supplied to them on their arrival in Kenya. We have all those items are zero rated. And that also applies to those arriving for new contracts for a period of 2 years in Kenya. If you have diplomats are coming for a period of 2 years contract, then any goods or services to them are zero rated. They are zero rated. They are zero rated. But of course, we have exclusions, which include the hotel accommodation, restaurant, and even entertainment services that are generally not zero rated for such entities unless specifically provided for in law. So that is diplomatic missions, consulates, and diplomatic agents and their personnel. That's the first category of privileged persons and institutions. Number 2, we have United Nations. The second category, United Nations. The UN, the United Nations, and specialized agencies. And specialized agencies, these also are privileged persons and institutions. They are accorded special VAT. All taxable supplies, both goods and services for their official use or for their projects, are zero rated. We may also have employees of the UN. So we have these bodies, these are bodies including their employees. The employees of the United Nations, the employees of specialized entities, the employees of the UN, and these specialized agencies, and that is just similar to the diplomatic agents and their personnel. So we also have the employees of the United Nations and their specialized agencies. Those employees, again, candidates, their households and personal effects, including one motor vehicle, okay? Including one motor vehicle on first arrival in Kenya, are zero rated under specific circumstances. You understand? Yes. Then 3, Commonwealth. Commonwealth and other governments. And other Commonwealth and other governments. These are goods consigned to officers or men on board a naval vessel belonging to another Commonwealth government for their personal use or for consumption on board on such vessels. We may also have goods for use of any of the armed forces of any allied power, Commonwealth and other agencies. Donor agencies like the bilateral and multilateral agreements. We have certain donor agencies, if they have specific bilateral or multilateral agreements with the government of Kenya that provide for tax exemptions, may also benefit from zero rating of the imports and supplies for official use or even for special projects. And that often includes their entitled personnel's household effects and vehicles on first arrival, donor or multilateral agreements. Then we can include international and regional organizations, national and regional organizations. International and regional organizations. We have other international or regional organizations that may be granted zero rated status based on specific agreements or legal provisions. Then we can go on and also mention bodies like humanitarian and relief organizations. Humanitarian and relief organizations. Humanitarian and relief organizations like the National Red Cross Society, like the St. John Ambulance. These organizations often benefit from zero rating on certain goods and equipment for official use. We may also have goods for emergency and relief purposes. We have taxable goods that are acquired by relief agencies and NGOs for use during disaster periods or in refugee camps that may also be exempt or zero rated. 7, war graves Commission. War Graves Commission. These are supplies to the War Graves Commission, zero rated. They are typically zero rated. So these are 7 categories of persons and institutions that are accorded special VAT treatment in Kenya, which means that the supplies made to them and the imports that they make are taxed at the rate of not pay tax, VAT tax.